Eric Mother.com with another mentorship video. Now the purpose of this video is to see whether we can discuss some of the elements of a situation where the market can turn around. So I hope by the end of this video you can have a better understanding of some of the factors that we can use to determine when we can go back into a market after it has been pulling back. Right now, today we are seeing the market trading close to the lows of the day. Actually, the lows of the day was at about 140, 150 on the Dow. So it's come off the lows. And so now the question is, if somebody was looking for a reason to get back into the market, where would they place some type of a bet? Of course, when you place the bet for a rebound, sometimes it works and sometimes it doesn't. But that's not to mean that you can't try. And here we're going to be discussing what you can consider. And at least if all of these things come into play, then you can see that the odds tend to be favoring a rebound. So here we see the market down for the day, and it's Monday and it is July 27th, so that down the road anybody watching the video 2 years later can take a look at what happened after this video and see whether there was what we are discussing here made sense at the time. Okay, so Dow down, market down, and so traders are looking for a reason to get back into the market. So let's go fast and take a look at what the market looks like. To begin with, over the weekend we talked about the fact that the NASDAQ already gave us this sell signal when it came here to this line and showed resistance. So the sell signal makes sense. Alright, now if you're looking for a rebound this week, just keep in mind where the NASDAQ is trading, because this RSI, should the RSI move below 50, that's going to be a big down week irrespective of what the other charts are saying. So if it can hold above 50, maybe there's a chance of a rebound. Now what I'm saying here is when markets are moving below 50, don't expect a recovery for that week. Maybe you can play for a rebound towards the end of the week or at the beginning of the new week. As an example in this video, I'll show you this instant here when the NASDAQ was moving below 50, corresponds with this drop for 2 weeks there, and it's only at the recovery back above 50 that the market started building higher. So once you see the market moving below 50, you expect the pressure to be to the downside. Once the market snaps back and moves above 50, then the pressure tends to be indicating maybe a market that wants to rebound. So for this week, one of the things that is actually making it interesting for a potential bounce is maybe the market is testing this line here, and this line on the weekly starts by connecting all these highs here and recently this low. Now we can draw it through this period here because it's uniform activity. In other words, if you draw a line connecting many lows, so maybe this is a low, another low, another low, and then you get another low like that, and then some other point down the road confirming the previous line, you can draw your line through this low because this is uniform activity right there. So you can actually, it's legitimate to draw a line through there. Hope that makes sense. So again, and this is supposed to be an educational video, so I hope you don't mind me going into some details here. So you see this line here connects nicely through all these periods, through this low because of uniform activity, and then connecting to that low. So if this can hold for this week, then maybe the market is playing for a rebound. Now take a look at the NASDAQ daily, and on the daily, a couple of things. Number one, we have to be sensitive to the idea of a potential move back above the 50-day moving average, so we start looking for reasons. Now remember, when you're looking for reasons to go long after a pullback, now we made a high here, we pull back over the last 3, 4, 5 days. If you want to play the market for the next swing trade, you have to initially consider the monthly charts, what they look like, then consider the weeklies, then go to the dailies, go to the hourlies, and then go to your minute charts. In other words, you want to start with a bigger time frame and grind your way down, trying to find out how the smaller time frames are playing out in relation to the bigger time frame. So we start with the big time frame. If we go back to the NASDAQ monthly, just to keep the video a little bit relevant, NASDAQ monthly, you see here that the monthly for the NASDAQ has been holding above 69.1 going back about 2.5 years. So it's been holding above 69.1, so which means it is strong. If it drops below 69.1, expect there to be a deeper correction. But if it holds, and like right now the NASDAQ is holding above 69.1, the indication is that maybe this is just a shallow pullback before it recovers. So the monthly looks like it could be telling us the market could be actually make sense if it stays stable. So we come to the daily after we looked at the weekly previously, and the daily has come back to this potential, and it's just potential. We don't know. Remember, we are playing with percentages here. We don't know. So if this line becomes another bounce area, if the market holds here, right now it is trading here with about an hour and a half to go before the trading session. So I would say that maybe this is going to play out tomorrow or the next day. If this is going to be where the market finds stability on this line, like it has been doing over the last couple of months, over the last couple of years actually, bouncing on this line is where the market has been coming back. Uniform activity below the green line, back above it, gave us this re-entry, and all these periods here, market's been bouncing with uniform activity back above the green line. And so again, if this recently we saw double bottom uniform activity below the green line and back above it for this re-entry in the market somewhere there. Now, so my thinking here is that if this is going to be a bounce, I don't know, you don't know, but if it's going to be a bounce around here, it's going to hold that green line with uniform activity. So you have to give it about 2 days, 3 days to play out. You don't have to rush in there, or you can start buying with small portions. Also, there's another line of consideration, which is this line here. If this line holds, which is the line connecting the previous RSI lows, so if that line holds also, if this holds here, remember this is uniform activity, it looks like this. So let me explain. So this bottom, 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 and then it's done something like this, which is uniform activity, and then it's come back here. It's resting on this line right now, which is here. The double bottom is this level here, and then this low is this low, and then this low is this low here. I should have drawn it closer. This should have been closer like that. And then of course this low here is represented by this low. So here we see that if the market can hold that line where it has come back to test this line, if it can move back above this line of support, then somewhere around here this can also be looked upon as a legitimate entry point in the market. So what I'm getting at here is, because of where the market is trading on the RSI, we start looking for any reason that could suggest that yes, the market could bounce. So the dailies are showing that sign. Now I want to show you the hourly, because the hourly is giving me a different picture. Whenever markets are trading below 30.90 on the hourly, the market is not gonna bounce. It's gonna bounce, but only for a short-lived bounce. For example, take a look at this move below 30.90, corresponds with this low. Market went up, came back to test that line. Check this level here when the market was below 30.90, which is this period here. It went up, came back, tested that low and broke it. So now if the market trading below 30.90, it suggests that at the very least there's going to be a movement higher, and then another attempt to break recent lows, maybe even break the recent lows. In other words, you don't necessarily start a big move when the RSI has gone below 30.90. You start a move like we did during this period here, because the RSI refused to go below 30.90. So that refusal to go below 30.90 during this period was during these lows, and as we know, the market jumped and had a nice recovery. So because the markets are trading below 30.90, don't expect a snapback rally for now. In other words, you need the market to refuse to go below 30.90 first. The refusal to go below 30.90 is a confirmation of strength. And so we need to see that. Also, it might be good to see lower prices with improving technicals. And we haven't seen that here. And this is the last time we had improving technicals here, higher high in technicals, lower lows in price. Eventually that was good enough to engineer this nice recovery. Also, your markets are not going to recover until both the MACDs are above zero. So markets don't move higher until the hourly MACDs are both above zero. So just take that as a fact. In other words, you get a move higher, but it's not going to be sustained. It's only when both MACDs are above zero that the market can hold on to gains. And that's just how it plays out. Like, for example, during this low here, or this lows here, take a look at the RSI. So we are talking about this period here, that period. Take note that the market made a low right there on the hourly. RSI improved here. MACDs moved above zero there, and also the other MACD moved above zero. So what I'm saying is confirmed even in this example. Markets don't move higher until we see improving RSI strength, until the hourly MACDs are above zero. So because right now none of the MACD is above zero, I would not be looking to buy and wait for things to play out. It might take a day, it might take 2 days, it might take a week, it might take 2 weeks. But this means there's no need to rush and look for opportunities. Take a look at the 30-minute chart for the NASDAQ, and you see here the same type analysis. RSI is trading below 30.90, which means there's no hope for a recovery here. Any move is gonna have to be tested and probably make fresh lows. We take a look at the MACDs right now. Both of them are below zero on the 30-minute time frame, which means there's no chance of a recovery. All right. Now, even on the 30-minute chart, I want to show you something here. The only time the market had a chance of this nice recovery off the lows, and anybody who played this swing trade from here to here had a chance of making some good returns. But more often than not, you need to see improving price strength, improving RSI strength with a higher low, and the RSI refusing to go below 30.90 like it did here. RSI refused to go below 30.90. In other words, it can go below 30.90 and back above it with uniform activity. That's still a rejection. Rejection at 30.90 with uniform activity is rejection either way. And you see here that we had improving RSI strength, declining price strength, and eventually that improvement in strength on the technical side led to this recovery. And also that period corresponds with when the MACDs also, so we are talking about this period here. This period also corresponds well with when the MACDs moved above zero. So the MACDs have to be above zero for a market to recover. Even here the MACD was above zero. So the MACD is when the MACD moves above zero and both MACDs are above zero, then that is when strength is confirmed for a potential move. Right now we see that there is no strength confirmed. Now I don't want to repeat all the charts here, but if we take a look at other charts, and we won't go into details because it's the same thing, we see that the Dow is also potentially cracking. Maybe this crossover here between the Dow, where the 13-week moving average and the 34-week moving average are crossing and undercutting each other, this could be a bearish development right here. In fact, let's go back a couple years, and we see the last time this happened when the 13-week moving average crossed under. So bear with me here. Let's go back about 5-6 years weekly. And on the 6-year weekly, what we see that the last time there was a crossover was here, which was a bullish crossover between the 13-week moving average moving above the 34-week moving average. That crossover began a nice move from 2013 with the Dow at 1200 all the way to the Dow trading as high as 18,000. Since then, we haven't seen a bearish crossover between the 13-week and the 34-week moving average. So right now we might be looking at that type of situation where the 13-week moving average could be predicting that by moving below the 34-week moving average, we are going into a different phase in the market. Now, it's very important to understand that if we are going into a different phase in a market, in other words, if we are going into a bear market, then you absolutely should not be looking to buy. In fact, you should hold your nose as best as you can and not buy, because you are buying when the market has given you a long-term sell signal. So be aware that this crossover between the 13-week moving average and the 34-week moving average could also be suggesting that this market could actually be at the beginning, or let's put it this way, the market could have already given us some signals that it is about to go into a major bear market crash. Why do I say that? Take a look at this resistance on the weekly RSI. We've been making lower lows for about 2 years. I know that makes no sense, but let me give you a fresh chart for the Dow again, because like I said, you have to begin by taking a look at the long-term picture before you try and find an opportunity to get back in the market. But you can see here, since about 2014, maybe even going back 2013, this market has been making higher highs on the weekly, continuously making higher highs on the weekly over here, yet the RSI has continuously shown lower lows. So the RSI has been showing rejection on this line. So that could indicate that over the last 2 years, this market has been making higher highs while the technicals have been declining. And now we see the early signs of 13-week moving average undercutting the 34-week moving average, suggesting that maybe, just maybe, it's a broken market. And if there's a chance that it's a broken market, the last thing you want to do is be part of any any short-term rebound, because you're going to just walk into a sell-off. Now, there's also another argument that maybe this could be where it breaks this line here. A break of that line would be a major break, because this connects to the lows going back about 4 years to 2011 on the RSI, and looks like the RSI now is breaking below that trend. So this is a serious point in the market. If this breaks, it opens the possibility for lower prices in the coming weeks and in the coming months. If that's the case, you have to be aware that this market could actually be going into a major correction, and you don't want to be buying hoping for a move to new highs. Maybe we're not going to see a move to new highs again. Now, over the weekend, I talked about the Dow also coming close to the possibility of forming fresh 3-year lows on the monthly RSI. If the Dow is looking to make fresh RSI lows, 3-year lows on the RSI, so 3 years back, if the RSI makes fresh 3-year lows, that's going to be a major sell signal. Okay, that is something it hasn't done since the lows of 2009. That's a major sell signal. And I also talked about the fact that the MACDs could actually also be looking to trade to fresh 3-year lows, and they're doing exactly that. So one of the MACDs is already trading at fresh 3-year lows, suggesting it is not out of the realm of possibility that we have begun a major bear market. And that's why when you're looking for your reasons to go long a market after a shallow pullback, you have to be aware how the other time frames are behaving. And so it helps you understand whether you should make a strong bet and whether there's the chance of a strong rebound are going to take place. So the Dow is also giving us signs that maybe it could be looking to stall. Now, go to the Dow daily. Remember, we are looking at all time frames, and we see that yes, there's a price break to fresh lows. All right, that's true. But we also see that the RSI really hasn't broken down. The RSI is the key. RSI is coming back to this level where it has been bouncing. No need to show you all the points, but if you pause the video, you'll see that that's true. It's come back to this exact level where it's been bouncing. Also, it's come back to test the line connecting RSI lows. So if this line also holds, the blue line, if that holds and the Dow is back testing that on the RSI, that's good if that line holds, and also if it holds this line here. If those two lines hold, maybe the Dow can find support. So in the next couple of days, if we look and see that the market is bouncing on this line, then that's exactly where we should go long, irrespective of what the price looks like. All right, take a look at the Dow from an hourly chart, and we see again reasons not to be expecting a strong pull or a strong reversal higher, because number one, we are breaking the line connecting the lows. Number two, The RSI is trading below 30.90, and that's a red flag. We don't want to own instruments that are trading below 30.90. All right, that's not good. And we also see that our MACDs, both the MACDs are trading below 0. And so because the MACDs are trading below 0, that suggests to us that this market is not looking to bounce. We need both MACDs to be above 0 if this market is to truly bounce. Now, I'm going to show you a couple of other charts, but I won't go into details. We take a look at the Dow Transports. It needs to hold this line. If it holds this line on the weekly, which has already given us a double top or double bottom, if this becomes a triple bottom, then maybe there's a chance to look for long side opportunities. If it breaks, that's bearish. Take a look at the Dow Transports daily, and we see that it too has come back to a level of where it has been finding support. This green line has been support for quite a while for short-term bounces, and it is also looking to come back and test the line connecting RSI lows. If those 2 points hold, then this market could actually see a bounce. So that's why we should not give up on the idea for a bounce. You take a look at the S&P 500, we see that this week, if it doesn't move back above 50 on the weekly RSI, expect it to stall. Otherwise, if it turns positive for the week and moves back above 50, that would suggest a strong recovery. Why? Because it closed the end of last week just at about 49.90, and so any movement back above 50 this week would suggest a strong weekly closing movement. Now, that's the positive side, that it could recover and go back above 50. But the problem is, we talked about this over the weekend, that we should not go long so long as the S&P 500 is trading below 50 on the weekly RSI. So given that, there's no reason right now to be long or to be buying, because the market has already decided that it is down for the week. It's only when the market turns positive for the week that we can start looking for long side ideas. Now, S&P 500, again, we've already discussed this on the NASDAQ and the Dow. RSI is trading below 30.90. That's bearish. It means that there's not going to be a rebound or a strong rebound until we see the market move the RSI above 30.90 and then come back and test 30.90 and be rejected and move higher. And then we need the price to go higher for a little bit and then come back and test these lows, maybe even break them. It's only when we see this improving RSI strength on the hourly that we can find a reason to go long. For example, just like you can see here, during this period, RSI moved below 30.90. That was not your low. That was not your low here. This is this period here. That wasn't the low. The low is when the RSI refuses to go below 30.90 here, improving RSI strength, and the price made a new low, and that was good enough to launch the market for a nice short-term swing trade higher. So right now, this indicates that there's no possibility of a bounce, or at least a strong bounce which is not going to be tested again. So the chance of a test and the chance of breaking those lows suggests that you have to be patient and wait for the hourly RSI to move below 30.90. And again, this might take 3 days, might take 5 trading sessions. So you have to be absolutely patient. Wait for the formation to take place. Just be patient as you can. Okay, now let's take a look at, let's see what we got. We can take a look at, now I want to show you something else, which is the VIX. The reason why I bring up the VIX is the VIX over the last 2-3 years has been a very good tell as to when the market is gonna. Before I do that, let me take a look at this instrument here. This instrument moves inverse the VIX, and SVXY moves inverse to the VIX, and the VIX, pretty much when the VIX is moving high, markets go down. We all know that. All right, so we see that at this point here at the highs, recently it came back and hit this very simple line connecting recent RSI highs. And what I want to point out here is today, now this is Friday's close, today's Monday. This is Friday's close, the 24th of 2015. It closed with its RSI at 53. So today it's moving below 50, hence it's having a big down day, which suggests that the markets are not going to recover. Whenever these instruments are moving above or below 50, you can tell how the market is going to respond for most of the day. Because today it's moving below 50, it indicates that the market is going to be down into the close. This can also be seen by the VIX, because if you take a look at the VIX on Friday, it closed with its RSI just below 50, suggesting today it's moving above 50 on the RSI, which is why it's having a 16% jump. But now the problem comes with, now that it has already moved, you can start looking for reasons why this can stall. And one of the reasons why it could stall, quite frankly, is because if you take a look at this line here on the RSI, this is where it's been stalling. So if it moves back to this red line and stalls, then this is where you can start looking for reasons to get back into the market. So if it gets back and it's very close to the red line, if it stalls at the red line where it's been stalling over the last couple of years, then this is where you want to look for reasons to go long. Now I want to take a look at the VIX hourly. Let's take a look at the VIX hourly 6 months. So this is 3 months. Let's go to 6 months hourly. And I'm going to draw another line, which is where the VIX has been stalling. Like that. You can draw it right there. So right now we are looking at the VIX trading slightly above the red zone. Now this red zone has been where you had to definitely get back in the market during this move. When the VIX would come here and show resistance, you had to buy the market over the last 1-2 years. This has been very successful, and I've used it with a lot of good turn points indication in the market. Even here, resistance gave us that high. Recently we went above the red line and back below it with uniform activity, which gave us this high, and then another failure to move above the red line. During this high, the market was an absolute buy here. So now we see that the market has come back to the same level. If this becomes a stall point and we have uniform activity move back below, so if the VIX moves back below this red line with uniform activity, let's say at the end of the day it looks something like this. If it moves back below the red line with uniform activity, then at that point you absolutely have to start looking for reasons to get back in the market. So I'm watching the VIX to see how it behaves, because the first indication that it is showing uniform activity and the first indication that it is staying below this line indicates that we need to be looking for reasons to get back in the market. I hope I'm not talking too much and not trying to explain this clearly. In other words, if the VIX stays above that red line, then this market goes lower. And I think that's another way of looking at it. If the VIX is above this red zone, the market moves lower, the VIX moves higher. But if the VIX stalls and goes back to the red zone where it's been stalling for quite a while, then you have to be looking for reasons to be long. Now, as I record this, I just want to show you what the price action right now is doing for the market, so that this video can have a little bit of a relevance. And we still see that the market is continuing to make lower lows for the day. Now, keep in mind, we know that the RSI and the MACDs are indicating that the market could actually be lower. The VIX is moving above 50 today, suggesting the market is going to be under pressure for most of the day, maybe even going into the close of the day with about 56 minutes left for the day. Okay, so let's take a look at some other ideas. Remember, what we are trying to do here is find a reason to get back into a stock or into a market. Let's take a look at NVAX as an example. We start with taking a look at the monthly. The monthly right now is above 69.1. So the monthly is showing us it is strong. So we can look for reasons to get back in the stock because the monthly is strong. We go to the weekly. The weekly right now is still holding above 69.1. And as long as the weekly is holding above 69.1, maybe it has a chance of bouncing. If it cracks below 69.1, any move below 69.1, just like it did here, would indicate that there is more downside, even short term. Even this move below 69.1 during this period indicated there is more downside. Even this move below 69.1 indicated there is more downside. But if it holds above 69.1, it also shows it is strong. We take a look at the daily, and the daily is at an interesting conjuncture, because take a look at this line connecting recent RSI lows. That connects nicely to these lows, this double bottom, and now it is testing that line. If that line holds over the next 1, 2, 3, 4 days, maybe even more, if that line is confirmed as support, then this is where you can look for a rebound on a stock that is coming off recent highs. Otherwise, you got a couple of options. And all you have to do is draw lines. There's a line connecting this point here. Why is this line significant? The line is significant because the most recent move in the stock, so the line broke out, the RSI broke out there, corresponds with this price breakout, and the stock went on a nice run from $9 to $13, which is about 40% move. And that 40% move is why this line, this breakout line, was important, and this line was established after the stock formed that wedge. Let me draw that again. So the stock blasted out of this nice wedging pattern here. That wedge, once it broke out and blasted above that wedge, the stock went on a nice run, which is this period. Now you can take this topside line and extend it, and you can see that the market is back testing this line also. In other words, it moved above the line and has come back to test it. If it holds, plus if it holds the other line that I just drew, so there's another line. If it holds this line, if those two lines hold, this line and the second line, let me use a different color. If this line also holds that back test, if those two lines hold, this is where you can look for opportunity for the stock to bounce. Otherwise, short term, if those two lines are broken to the downside, expect the stock to move lower. So either it's going to be support or no support. Now, there's also another line that I need to draw, and I'll show you why. You can see that off the lows here, that there was an RSI breakout. So RSI broke out of this wedge here, short-term wedge. And so you can see that we can take that, this movement in the RSI there began this nice move off the lows recently at about 750, somewhere just under $8. Draw a line from there. You can see that in the future, this is the line that you can expect uniform activity bounce. If it ever comes to this line and shows any type of uniform activity, double bottom, U-type formation, or maybe this ball type situation, any type of support, or maybe even a triple bottom, any type of uniform support on this line down the road in the coming days, coming weeks, coming months, would be a reason to go along the market. Now this line is legit because if you go back like that, you see that it also gave you this entry. Even in traveling backwards, in analyzing this line backwards, the green line, in analyzing it backwards, we see that it gave us this nice entry here during the lows here at about $4, and there was also a rebound territory here during this lows. So that line is legit. So in other words, the real test for this stock is down the road if it ever comes back to this line and shows uniform activity. Just like it showed uniform activity here for a nice bounce, double bottom uniform activity here for a nice bounce. So even though currently we might have a chance of the stock giving us support based on this line and also based on the other line, which is this line, right now, oops, let me do that again. Nope. Give me a second. Let me get the right color. All right, let's go to magenta. All right, so if those two lines hold, then currently this is the support zone. It either needs to hold here and bounce or break to come and test the green line. So that's how you time these things on a short-term basis. The other stock that I mentioned this past weekend on a short-term consideration basis is NHTC. This stock has been on fire. Take a look at the monthly. You can see that the stock has moved over the last 2 years from about $1 all the way to $45. An absolute screamer of a stock, absolute gem. We see here it moved back above 69.1 and had a nice run from $12 to $45 again. Now it's moving its monthly RSI below 69.1. Now here's something you have to consider. We are coming into the end of the month. It is July 27th. So in the coming month, if it can move back above 69.1, or in the coming months, any month it moves back above 69.1, it could show that it had another chance of moving higher. In other words, just like it did in this period here, it went below 69.1 for a pullback, but it recaptured strength once it moved back above 69.1. So as we come close to the conclusion of this month, we don't give up on the stock, because in the coming month, any move back above 69.1 would suggest that the stock has fully rested and might be looking to bounce. So the monthly is not discouraging. We go to the weekly, and the weekly to me is encouraging, because if we go back to 3 years worth of data, let's go back and get 3, maybe 4 years of data on the weekly chart, we see that ever since the stock broke out of this area here around the 50, ever since it moved above the 50, it has been using the 50 for a bounce. So the 50 level was a bounce during this period here, which corresponds with this nice entry there. It bounced off the 50 again, which is this nice entry. Right now the stock has come off the highs from 45. It's trading at 24.80. So 24.82 is where it's trading. If it can hold this line and bounce back above 50 on a weekly RSI time frame, then this period right here where it's trading is where you might consider going long for a rebound. So that's what I would consider. We take a look at the daily to see timing here, and the daily doesn't look very hot, because if it was truly about to bounce, let's take a look at 2-year daily. You see that the line it needs to be above is this line here. It's been bouncing on this line. Let me draw that again. Oh, somewhere there. So the daily is not encouraging unless the weekly can move back above 50. This is the line it needs to be. It needed to hold this line with uniform activity like it has been doing over the last 2 years and bouncing. Uniform activity even here for these lows. Uniform activity here for some small time lows there and a short bounce. Right now we are looking at the potential of a break. In other words, it needed to hold the green line. It's not doing so. So I would actually use them. On this one, the daily is not encouraging. I would rather use the weekly, because if the weekly can hold this 50 level, then this is where you want to go long. In other words, that's the consideration I would use. I would also want to see that the market is moving higher. Remember, 75% of a stock's gain is going to suggest that the market is also moving higher. So we want the market to confirm strength, and then we can find stocks that can move and move faster than the market while the market recovers. So that one is one I would watch. If the RSI is back above 50, I would consider buying. All right, take a look at one more. And here is CYBR. Now CYBR bounced. Now this is an IPO, so it doesn't have fully developed RSI. So we have to go to the weekly to show us long-term picture. And as of right now, the stock has refused to close and trade below RSI 50. It held RSI 50 here, and recently it held RSI 50. So this one is one of interest, because the more it shows strength by holding RSI 50, the more it shows it could bounce. On the other hand, if it cannot hold above 50 and fails, so if the RSI can't even hold 50, then I have no reason owning this instrument. So right now it's doing exactly what it needs to do, is hold above 50. We take a look at the daily, and the daily needed to hold this line. So the daily looks okay in my opinion, because this was the line where it was supposed to test. After this breakout, during this breakout, the stock went on a nice run from $35 all the way to 17 in about 2 weeks. So it more than doubled in about 2-3 weeks there, actually within 3 weeks. And since then, it has come back to test the green line. And as you can see, the green line seems for the most part to have held with uniform activity. It's not the best, but it's okay. In other words, it's a multiple uniform activity action. It looks like this. So this is the green line. And of course, this here can be seen, it bounced off. So the level here is this entry. And over the last couple of weeks, it's come back, did uniform activity, uniform activity, uniform activity, uniform activity, and back up. So it's a multitude of uniform activities. Each one is uniform activity back to the line, uniform activity back to the line, uniform activity back to the line, and then uniform activity back above the line. Hope that makes sense. I'll do that again, because this uniform activity business is important if you understand it. So it went below it, came back and touched it, went down, touched it, went down again, touched it, did something like that, and now moved above it. Now all this is this period here. We are talking about this period. This is what's going on there. Each instant is uniform activity. Hope that makes sense. What I mean by that is that by itself is uniform activity. That by itself is uniform activity. That by itself is uniform activity. And that by itself is uniform activity. And by uniform activity, I mean its relationship to the green line. It's moving below the green line and back to the green line with uniform activity on each example. Hope that makes sense. I'll do that one more time. Uniform activity there. Uniform activity there. Slight uniform activity, and then a bigger uniform activity. So even though it looks like it is not uniform activity, if you break it into small portions, it's uniform activity. And so recently what I'm trying to say that this stock has already given us a buy signal, in my opinion. And as long as it is holding above this green line, this is one that should do well over time. But what I could suggest you can do here, because there's a problem, and the stock market is reading charts is an art form, because there's so many things going on. Recently I talked about the fact that the stock was struggling to hold the back test of this line. It broke below here, failed to hold the back test. So that was a sell signal short term. That's why it's down 4% today. And it's also down 4% today because it moved below RSI 50. Yeah, baby, it's not that complicated sometimes. Anyway, and then again we see that it broke this trend line, and you can also look at it like this. So this red line is resistance. The best time to go along this stock is when it moves back above that red line of resistance. So in other words, the break point was tested and failed recently, which is this line, and that break point here was significant. Why was it significant? Because it killed the rally off the highs. It killed the rally. So that line there has become a problem. And again, I'll draw it one more time. If this stock is to do well, it needs to take out this horizontal line where it has struggled to move up. Once it broke down, it became a problem. It was confirmed as a problem here. What I'm getting at here is the stock is only a buy once it moves above the red line, which means it is trading above the red line. You need it to be trading in this green area if it's going to record higher prices. We haven't seen that, so it's stuck between a buy point on the downside and a sell point every time it moves higher. So clearly, if it can move above the red line, then it rallies. If it breaks below the green line, then it sells off. So if you want to play this instrument, the best thing is to wait for it to break out above this line of resistance somewhere there. The video was slightly longer than I intended. I thought it was gonna be like a 10-minute video, but no. Sorry, it happens. Sometimes we get a little bit waddy and we explain things too much. Anyway, so okay, so how do I conclude this video? How do I conclude? This video was meant to help you gauge when to get back in a market. And it's always going to be tricky because it's a science. It's almost an art form, and you have to train yourself. You have to look at charts for weeks. You have to understand charts. You just have to study them, and you have to understand what's going on. It's very confusing, and people try their best to time markets, but it's not as easy as it might seem. But you have to start with the bigger time frame to the smaller time frame to understand this. In conclusion, I want to show you one thing here. We are looking at crude oil making a fresh, almost making a fresh low as far as the USO is concerned. Now, anybody who has been timing this, and I've been talking about this for a long time, there was no point to try and own this instrument during this period here. I kept saying it. I've been saying it for a long time. And it's not that complicated, because if you take a look at the long-term monthly chart, I talked about the fact that this had become resistance. In fact, let's go to crude oil itself, and again here I go making the video even longer than it was. I hope you don't mind. This line became a problem. You can see this line was support going back to 94 actually 1994, yes, 98, and lows of 2008. The market tried to move back above the red line and failed. And I've been talking about this resistance being a problem for about 2 months. Now we see that the RSI is trading below 30.90 for crude oil, because today it is trading at, let me show you the price of crude oil. And for today we see that crude oil, and I might not show you this clearly, but today the crude oil price is at 47 right there. You can't see it, but it is at 47 there. And so that has always been the problem, that it could make fresh lows. And I was trying to impress on anybody not to try and time this instrument, because the long-term picture was not good. Take a look at the monthly RSI. Moving below 30.90 was never a good thing. So the long-term picture was bearish. So I've been saying for a long time, the odds were for crude oil to make fresh lows. And so you don't want to buy things when the long-term picture is bearish. Remember, if the long-term picture is bearish, do not think of trying to find a bottom. It's going to be very hard. And also, if you take a look at the USO trade from let's go to a weekly chart. All right, it's trading below 30.90, which is not where you want to go looking for instruments. And also on the daily, trading below 30.90, you don't want to go buy any instrument when it's trading below 30.90. Why? Take a look at this period here. RSI was trading below 30.90. Anybody who was buying during this period made a major mistake. It's only when the RSI was rejected at 30.90, the RSI refused to go below 30.90, prices made fresh lows, RSI improved, in other words positive divergence, and from then on we had a slight move from $16 to about 21. That's not a bad trade. So when the RSI is trading below 30.90, there is no need to be looking for reasons to go long. Right now it is trading below 30.90, which means it might have a chance of a snapback rally, only to be forced to test the lows. Sometimes the lows hold, sometimes the lows are violated. So it's not that complicated, to be honest, guys. These markets are trading at fresh lows, and you can see here that maybe the hourly is improving. You see here, anybody who was buying this situation here because the RSI was below 30.90 made a mistake. This is what I'm talking about. RSI below 30.90, don't buy it here, because it's gonna test the lows and this one tested the lows and failed, and now it's making fresh lows. And we see that the MACDs are also trading below zero. So why would you be looking to buy an instrument where the RSIs, the MACDs are below 30.90, and MACDs are at fresh lows, trading below zero? So then again, we see that here's another market that is not looking great. In conclusion, let's go back to the Dow hourly. Dow hourly below 30.90. Dow hourly trading with the MACDs below zero. Oh, I meant the Dow RSI is below 30.9. So Dow RSI below 30.9. MACDs below zero. This is not where you want to look for bargains. You might want to wait for a couple of days, maybe a week or two, for the market to give you improving technicals before you can buy. Eric Muad with Muad.com. Again, video a little bit too long, but I hope you got something out of it. If you got something out of it, then it was worth the length. Okay, my mouth is dry. Eric Muad, good luck. Peace and blessings. Woo! Yeah! Woo! Love it. Yeah, baby. That was great. I am out. Mwah.